Thanks everybody for joining. Right now, you all have the ability to unmute, and I'd like to try and keep it that way. So please be cognizant if you have background noise, tapping, fire trucks, dogs barking. You can control your own mute button. If it gets noisy during our discussion and I cannot find you to mute you, then I may just have to mute everybody, which we don't want. But people can, we really want to make this as interactive as possible. Okay. It's like sort of like a workshop. And the topic is, of course, real estate and taxes and financial planning. Um, Gerry Hogenhout is a CPA, and he's been in the business for a long time. He cut his teeth at Deloitte Touche, and after a while, he decided to venture out onto his own. He wanted to focus not only on building a tax practice, but also on working with investors. He himself is a real estate investor, um, and a lot of his activities center around real estate and real estate investment, and taxes, both active and passive real estate investing. He's been licensed in many different areas to do with investing and private equity and mortgages and more. And I'll let Gerry, if you just tell us a bit about yourself and to start with, why real estate?
Well, thank you, David. Thanks for the intro. Well, as you said, I'm a accounting background, so I've worked with Deloitte Touche for 10 years in their small business and tax department, set up my own tax practice, which then I expanded into providing investment and financial planning services for my clients. And the more I learned about the investment financial planning world, the more you conceptualize it all. And David, you asked me why real estate. And whenever we talk about investments, there's, among many others, there's two main components. One is the rate of the return that we're looking for, and the other is what protects our capital. So over my years, I've just found that real estate, or let me rephrase that, the right type of real estate. So in my opinion, there's good real estate and bad real estate, but the right type of real estate really gives you the protection that most people want for their principal when we're looking at investment options and financial planning. So the answer to your question, why real estate, is because it's a good way to protect your capital. And like most people that have succeeded in building wealth, the majority of them have used real estate as that catalyst to build their wealth. And we're all chasing the same thing, just real estate investment opportunities. And it's interesting. Most people I find in the investment world, I kind of look at it as there's public assets and private assets. Public assets being really stocks and mutual funds that trade in the publicly traded stock market. So in my world, I categorize that as public assets, and then we also have the private assets, which again encompasses really a lot of real estate, certainly many other types of private equity, private assets, but primarily real estate. So there's been for years now, there's been less desire to be in the public markets, to get out of stocks and mutual funds and move over to what I call real estate related investment opportunities, which is a pretty wide umbrella. It covers a lot of things. So, we've seen this migration from public assets to private assets, and it just continues more and more as the stock markets become less desirable. And the more people understand, I'm a strong advocate of people really learning more about this stuff. And the more you learn, the more you realize, again, I don't want to be overly critical in the public assets because you can make a lot of money in stocks and mutual funds, but people are starting to realize the risk that's involved in that. And once you really figure out, the risk involved plus the rate of return that you hope to get or expect to get or are being told you might get, you start to rethink your strategy, and you go, okay, in my world, like, in my opinion, the whole industry has it backwards. And what I mean by that is the industry will start, let me back up a bit. When I talk to clients about investments or financial planning, I always suggest to break that up into two components. One is the actual financial planning process. So your roadmap, where you're going, where your starting point. So that's one part of it. The other part of it is the investment products that you want and need inside of your financial plan. And when you separate those two, you look at it differently. And the investment industry puts the product first, and then the financial planning process behind it. And what I mean by that, and I don't mean to pick on anybody, but I'll use Investors Group as an example. You walk in there, and right away, they're going to sell you an Investors Group mutual fund. So they're going to put the product first, and then they're going to build a financial plan around their product, which to me is wrong, backwards, about as bad as you could do it. It's, in my world, it's better to reverse that. Do the financial planning process first, figure out where you want to go, figure out, your roadmap. Then afterward, find out what investment product you want to put into your plan. And to me, that's a much better way. And it opens the door to really learn more about different investment products.
Okay,
I
Gerry.
try not to make
Yep.
I try not to tell people what product to use. I try to educate them, give them information so they can go, hey, I like that. And they might like stocks or mutual funds. They might like real estate. They might like insurance policies. They might like different types of assets in their plan. But to understand what I'm trying to say is that the whole, the way information is dispersed today is, in my opinion, is completely backwards. And if you understand that, then you can maybe understand what I'm saying, that to reverse it, start with your financial planning process, then figure out what investments you want in there, I think is a better way. Just my opinion, that's all.
Okay, very good, Gerry. So I'd like to talk more about investments in financial planning a little bit later, but let's talk a little bit about tax now, because this is traditionally tax time of year, and at this point, I'm not even sure what's happening with tax deadlines. Are there extension? I guess for regular employed people, they need to file usually around this time of year, and there's a RSP deadline coming up. What's the status with that? And also, what are some of the most commonly asked questions you're getting now? I guess there's probably a lot of questions, I would assume, around the CERB and some of the different subsidies and benefits and how those are to be treated. I wonder if you can comment on
Yeah,
some of that.
so the deadline, like in our world as accountants, we really have four major deadlines. One is February 28th, and that's a deadline for us to file any T4s and more importantly, T5s. T5s are dividends. We deal with a lot of clients with corporations. Dividends are becoming a much more preferred way of remunerating owners. So we have to figure that out, what kind of dividend we're giving the owner by the end of February. So February 28th is the first deadline. April 30th is the next deadline, which is really a personal tax filing for anybody that is not self-employed. If you are self-employed, then the third deadline becomes June 15th. And then the fourth deadline is June 30th. And that's our deadline for all our December year-end corporations. We have to file by June 30th. So there's the four deadlines that have always been in place. Right now, they have not pushed any of those deadlines forward. So that's very, very, very disappointing for us. Our CPA Association is lobbying very hard for the government to extend those deadlines. It's just, I mean, this year is the worst tax season we've ever seen, simply because all of these funding programs that they've provided, and there's many of them, the curve, the wage subsidy, the rent subsidy, the temporary wage subsidy, the emergency business account, the commercial, all these programs are filtered through the tax system. And so here we are as accountants in this tax system. And it's funny, I belong to a chat group of about 500 accountants. And whenever any of us have a question, we throw it out there to our group and everybody comments on it. And it's incredible, all these programs and how many questions still remain unanswered about whether people qualify or I mean, they, you know, take the curb, for example. It starts out, okay, the government stands up and we're giving everybody $2,000 and they give us some qualification for that. Since then, there's probably been 6 or 7 changes and adjustments to the curb as far as qualifications and changes and everything else. In fact, there's a class action lawsuit going on now with CRA because when the curb first came out, you had to have $5,000 of income in last year's tax return. Well, they didn't tell us if it was net income or gross income. So all these people are applying, and I mean, it's bad. It's really bad as far as the administration and the filtration through the tax system about all these programs. So, you know, as a CPA, you know, I just sit there and I say it's almost impossible for us to do our job properly, at least by the end of February, to get everything we have to do under normal circumstance, let alone this whole funding system coming through the tax system. I mean, the phones just are nonstop about people going, hey, can I apply for this and this and that? Now the government's sending out pre-audit letters that, hey, maybe you didn't qualify for the curb. Apparently, like close to 10 million people applied for this curb, of which apparently 25% of it is either fraud or, you know, they weren't entitled to it. So the system has to get the money back. I mean, I'm not showing my political colors, but I don't think they could have screwed this up any worse than they did as far as the administration of it. I'm not saying the funding is right or wrong. I'm just saying the administration of it. Like, why go through the tax system? If you're giving money away, like instead of giving people $2,000 that is taxable through the tax system, give them $1,500 and say it's not going through your tax system and don't worry about it. But anyway, that's just my beef for the day because I'm caught right in the middle of the tornado that the government has created for us in the tax world. So a little frustrating, but it's the way it is.
So, Gerry, now the government is handing out a lot of money to people who never got it before. I mean, for example, you know, students, I mean, who maybe even didn't even plan on working last summer, just as one example. And they're going to have to make it up somehow. What do you see as likely to happen with respect to taxes? Where is the government going to get some of the money back? What is likely to change in terms of our tax structure?
I'm not even sure they're concerned about how they're getting the money back. I mean, we're at $1.2 trillion now of national debt, which is just mind-boggling. And it's just not Canada; it's every country in the world. I mean, you know, the logistics behind just borrowing unlimited money is you know, quite interesting. Fiat money, you know, just computer money, a couple of computer taps, and there's your money. And the question, like, it's, you know, where does it end? I don't know, David. I have no idea. And you know, how do you repay $1.2 trillion? You don't. We'll never repay it. And you now are, you know, one of the things that we look at is our debt to GDP. You know, so what is our debt compared to what our country produces? And it's as high as it's ever been. It's astronomical. And you know, the economy has to, you know, how do you deal with that debt? Well, you know, and the other question, where is that debt? Okay, where is all this money? Okay, we have to issue bonds. So that, you know, how do you create money? You issue bonds and it goes through the Bank of Canada, and the bulk of the global debt is sitting in pension plans that fund these crazy pensions that public service employees are getting. You know, 1 out of 4 work for the government, probably globally, and they're all getting these crazy pensions, and that's all funded through pension plans. What's in these pension plans? Most of the bonds that are issued by these countries that just continue to go in debt. So where it ends, I have no idea. All I know is I feel sorry for the kids coming up because they're stuck with it. Most of us are lucky. Most of us, we've bought a house, and, you know, or 2 or 3 or 4, and had some appreciation on it. And, you know, we're probably well suited for, you know, later years. But these kids, my God, you know, and that's where, you know, jumping around a bit, but you know, the system has to help these kids. And, you know, as you know, David, I'm an advocate for it's funny that we're talking about this. I just talked to a client earlier this week, and I'm an advocate of somehow allowing people's RSP money to be used to help their children, or even other children, third parties, to help them fund their house. And there's no incentive. In fact, there's roadblocks and discouragement. Why can't a parent use their RSP to help as a mortgage inside of you? Most of you might know, or if you don't, you can hold a mortgage inside of your RSP as your investment product. And this client I just met this week, so they called me, they found me as a new client, never met him before. I guess he was calling for his mother. His mother was one of these public sector workers who had to transfer her pension. Her pension is $1.2 million. Okay, like that in itself is like, wow, okay, that's a nice pension. She had to transfer to her own plan, and she wanted to use it to do mortgage lending. They heard I can do mortgage lending, and so they asked me all about it. And I said, well, there's rules and regulations you got to follow about non-arm's length and arm's length mortgage. And they were appalled that there were so many restrictions. And I'll never forget the guy's comment is like, hey, it's our money. Why can't we do with it what we want? And that comment kind of hit home. And it's so true. And all this person wanted to do was help their kids use her windfall from her government job to help the kids buy a house. And under non-arm's length, we have to go through the same qualifying that we would at a bank. And so I'm saying to them, why would you use your money if you have to qualify anyway? Go to the bank and get their 2% money. But anyway, it was an interesting chat, and it was just more of a bitch session, really. That why can't I use the money the way?
So, but you have a solution for that, don't you, Gerry? You call it the child home ownership plan or something like that.
So yeah, one thing I've created is what I call child home ownership program, which we use people's RSPs to help to literally and yeah, it's glad you brought that up. And it's basically to use people's RSPs to buy a rental property. So where this came was I met with a client. She was like in her late 60s, just approaching the 71, where she had to riff her RSP, and she had like 350,000 in there. And so I was talking to her, and I'm like, okay, so what's your, the typical, what do you want to do with the money, blah, blah, blah. She had no need for the money. Okay, she had a nice pension. So she basically said to me, she goes, well, I mean, this money is going to my child. So she had a daughter, and she had a she had a daughter and a granddaughter. And I said, oh, so you're just gonna, she goes, I'm just gonna sit there, and I have to riff it. I have to take some money out. And then I'm like, okay, well, you're 70. And she goes, yes. And you have like no use for this money sitting in a riff. And she goes, no, it's going to my daughter. And I'm like, so then we get into the conversation about how hard it would be for her granddaughter to buy a house. And this is back 8 years ago. And then I said, so why don't we use that money inside of your RSP to hold a mortgage for a rental property? And then your granddaughter will eventually have a house to live in. And she just thought that was a great idea, as did I. And we did do that. So we literally took the money inside of the RSP, used it as a mortgage to buy a rental property. The daughter managed it. And so there's this little granddaughter who was 1 at the time. And then all these questions came up. Well, you're like, but the granddaughter is 1 year old. I'm like, yeah, so you own a rental property outside of the RSP. Now you let the tenant pay down the mortgage, just like any of us that have owned a rental property. That's the goal, have the tenant just pay down the mortgage. And then I said, your granddaughter, when they become 15, 16, 17, 20, 21, you get to decide, you can give it to them, you can sell it to them at fair market value, you can give them a discounted, price. So it all started to make sense. And then then it kind of a light went off in her head. She goes, well, the granddaughter, what if they don't have any money? Right. And then I'm like, oh, great. So let's just put it in perspective. We buy a house, $300,000, 20 years later, the granddaughter's 21. let's just say the mortgage is paid off and the granddaughter has no money. I said, you sell it to her and you create a vendor take back. You do a take back a mortgage. And I said, you have just created $300,000 asset. And so she was perplexed and like, I don't get it, she says. I said, just think of it. Your daughter would have to go to the bank. Wouldn't your granddaughter rather pay you instead of the bank? So you've just created a vendor take back. So you've created out of thin air, just like the banks do. 2 computer strokes, there's your money. So anyway, so if you can wrap your head around that, that was what I did back then. And I just wrapped it into kind of a package. And I call it the Child Homeownership Program. So I'm a real advocate to try to help parents, to help these kids get into the housing market. So that's worked well. But again, there's government rules that we have to deal with. And even for that program to work, we still have to qualify for that mortgage. And then you get to the point, if you're going to qualify for this mortgage, why don't you go get the bank's 2% money? And why would you use your own money and pay yourself 2% when the bank will give it? And it's funny when I have these chats with people, and it all boils down to the line I've heard the most. Well, I'm not making anything in my RSP anyway. And I'm like, you got a bigger problem. You have the wrong investment products in your RSP. And then I explained to them, and most of these people have been bouncing around in mutual funds and haven't made anything. And I'm like, you got the wrong investment products. And then I'm
Okay,
like,
Gerry, I want to ask you one more question about taxes per se, and then I want to talk to you about investments and real estate and the taxes that would be payable. There's a interesting point was brought up in the comments by Howard Lastman. We'll get to that, but is there talk about the capital gains exemption for personal residents? Is that
yeah.
going to be going away, and how do people protect themselves?
Yes. So yes. So you asked me before, where does all this money come to repay it? Well, obviously they're going to go to the tax system and change things. So we expect that. I think it's coming. And then the 2 target areas, I mean, it's going to be hard to raise the tax rate. We're already taxed, the tax rate is already very, very high. So I'm not sure that they can change the tax rate, but they can certainly change things within the tax system. The 2 target areas that I see them going after, one is the principal residence exemption. Okay, and 2 is the change in capital gains income inclusion. So principal residence exemption, here's a little quick history lesson. Capital gains actually came in 1971. Prior to 1971, there was no capital gain tax. When it came in 71, they gave people 2 principal residence exemptions. So you could have one for your principal residence, you could have one for your cottage. Okay, that changed in 81. They basically gave people, they took one away, you got one principal residence exemption. And that's been in place since 1981. Okay, so basically the house you live in, assuming it qualifies as a principal residence, which in most cases it would, is tax-free. Okay, and that's a great thing. Okay, and many of us have benefited from the principal residence exemption. They've been talking about going after that for years. They never have. I think this is the thing that pushes them over the top to start taxing our principal residents. Now, what does that mean? I would be absolutely shocked if it wasn't in at least a staggered, say the first million might be free or the first 500,000 might be free, and then they start taxing increments above that. That's what we all expect in the accounting world. That there will be some kind of a proration. So, and we cross our fingers that if they do attack that nice exemption, tax-free exemption, that at least, they go after the high income. But, if you make $2 million on your sale of your principal residence, yeah, maybe you should send something into the tax system. So, yeah, that's coming, probably sooner than we all want it. What do you do to protect it? Well, it's pretty hard. I've had a couple of clients where we've switched houses between companies. They had a rental and so there's some creative stuff you can do with a corporation, but you have to understand there's legal and there's the tax side of the equation. Okay, you can literally sell a house to your family member for $1. Okay, legally you can put it on paper as $1. the Income Tax Act says, regardless of what the transaction was at, we have to transact at fair market value. Okay, so we can't always use what the house is sold for legally. We have to go with fair market value. So anytime we're trying to do something creative to move a house from a personal owned into a corporation, we have to do that at fair market value. And sometimes there's good reasons to do that. There's a whole problem with owning a corporate asset and using it personally, which I don't want to get into at this point, but there are strategies. We use trusts. Okay, you can transfer a house into a trust. Okay, so sometimes we can crystallize the capital gain. Okay, use it first. Okay, so that's crystallizing, create the sale. Anytime there's a change of use, there is a deemed sale of the property. So sometimes, we can take a principal residence and convert it into a rental unit, and there's a deemed change of use, and we can crystallize that capital gain. So there are strategies that we can use for that principal residence exemption. It's coming at us. Be prepared. The capital gain inclusion right now, we pay 50 when we sell a property and create a capital gain. So now I'm away from the principal residence. Now I'm not talking about a principal residence. If you have a rental property, any type of an asset that you're selling to create a capital gain, you have to pay tax. And the one luxury we have in that area is that half of that gain is tax-free. The other half is taxable at your normal tax rates. So we strongly expect that half tax-free is going to get adjusted to maybe only 25% tax-free. So if you have a capital gain, you bought a rental property for $500,000, you sold it for $700,000, you created a $200,000 what we call capital gain. $100,000 is taxable. 50% of that is taxable. That $100,000 would go on your personal tax return at your personal rates. What we're thinking in that same scenario, that you have a $200,000 gain, you'll probably have to put $150,000. So they'll probably bump it up from 50 to 75% inclusion rate, we call it. So yeah, things are coming at us. It's not going to be good. It's going to be paying more tax.
Gerry, there's a comment here by Howard Lastman. I want to read it to you, and I'm wondering if you could comment on it, please. He says the real advantage in owner-occupied housing is the tax advantage and not a lower risk as compared with the stock market. How can you have a diversified portfolio with owner-occupied housing? Can you comment on that, please?
Oh, sorry. Okay, I'm reading it here. So the real advantage in owner-occupied housing is yes, correct, 100%, and not a lower risk. Well, okay, so we're talking about a principal residence. Okay, hold on. I'm not 100% sure I understand the answer. A question, not a lower risk as compared. Okay, let me deal with the first comment. When you talk about risk, the minute you pull money out of a guaranteed investment certificate, the minute you pull money out of a savings account, you add risk. Okay, and then you have to, basically you have to explain the risk. The client has to understand risk. So when Howard is saying, yes, there's an advantage in owner-occupied housing as a tax advantage, 100%, if it's your primary residence. What I'm talking about is if you bought a rental property, okay, the right rental property, okay, that's still occupied housing. And in my opinion, that has the ability to lower the risk of your investment compared to stock market investing.
So tell us about that now, if you will, Gerry, because I know you dabble at least in private investments, and that you like real estate very much, some passive REITs and so on, that we actually work together on, because in addition to being a mortgage broker, I'm also a dealing representative. Yes. So tell us about that. Why do you like some of these REITs? What do you look for? I mean, they're not commercial REITs, are they?
No. So when you talk about REITs, so REITs are real estate income trusts. Okay, and in simple terms, it's simply a fund of at least the ones I like are apartment buildings. Okay, so that's a REIT. Now, when you just say REIT, when you talk about real estate investments, that's such a wide umbrella. A REIT can be a wide umbrella. A REIT can be, again, a real estate income trust. It can hold commercial or residential. Okay, I prefer residential. It can be foreign or it can be Canadian. I prefer Canadian. It can be high risk or high value property or lower value property. I prefer the lower value. So my preferred use of a REIT is a residential REIT. I prefer the 2-hour radius outside of Toronto. I really don't like the Toronto market internally for a REIT, simply because the price point is just so high and the required rent is so high. But if you go from London to Kitchener to Owen Sound to Orillia to Peterborough and back down towards the GTA, you pick any town in there and you look at an apartment building. Most of these apartment buildings, when you drive through these towns, most of these apartment buildings are owned in REITs. Okay. Now, when you look at any of those apartment buildings and those buildings are inside of a REIT, first of all, they're very easy to understand. Most of us understand real estate rental properties. You collect the rent, you pay the expenses related to the building, and you have net rent. Okay. And if we own our own rental property, that net rent is ours. Okay. In a REIT, that net rent is distributed to the investors. Okay. Now, that's the geographic area I like. And it's not that I don't like outside of that geographic area, but why would I invest in a REIT in the US or down south or out west or out east when I have tons of them in my own backyard? And I'm much more confident. I'm still confident in the Toronto market itself, even though I don't really like the REITs in the Toronto market. I use the Toronto market to do our fix and flips. So I find if people want to get in and out quick, I mean, that's still a hot market to get in and out. But as far as creating an income, sustainable income flow, we look at that 2-hour radius outside of Toronto. Again, I like the low to medium. I don't want the fancy apartment building that's going to attract a really high rent. That rent range from $1,200 to $2,500 a month is very solid. The vacancy rates are nothing. There's still appreciation for those type of REITs that go in and buy these kind of rundown buildings, fix up the apartments, get the rents from $1,200 up to $1,800, and then we look at the sustainability of that income, and we go, oh, geez, again, kids can't buy houses. They end up in apartments, so the vacancy rates are nothing. People will continue to need apartments. The system is not well designed to encourage people to build apartment buildings, because the big developers, I mean, we're under rent control in Ontario, so we don't see a whole lot of brand new apartment buildings going up. So we're really using the existing buildings that are there. And then the question has come up a lot about, geez, now with this whole COVID, I mean, we all know what has fueled the real estate prices, certainly in the GTA and in the GTA area. It's immigration, right? Immigration has fueled the especially these surrounding areas. My God, I have a couple of places in Orangeville. I mean, that's just gone through the roof. It's incredible what the pricing has happened in the last, not only last year or two, but the last 10 years. So what's the sustainability of that? Well, we're in the middle of COVID. Are we going to keep opening the borders and keep bringing people in? Then you go back to our debt. We have $1.2 trillion of debt. How do you deal with that debt? You have to create economic activity. How do you keep economic activity going? Well, you open the borders and you continue to let people in. And that's what will happen. I think Trudeau's already said there's 1.2 million immigrants coming in the next 3 years. So as long as that keeps happening, I don't see anything changing in the fundamentals of that type of real estate investing.
Gerry, there's a question I'd like you to comment on here about whether you do taxes for real estate agents. And I'm wondering if you can comment on that from the perspective of the new PREC that came out, and also generally, is because there's going to be people here who are not real estate agents. So in terms of investing in a corp.
Yeah, so some of you are familiar with this, some of you are not. So when David mentions PREC, that's a personal real estate corporation. And the real estate industry has lobbied for years and years and years and years. I've done tons of real estate agents over the years, and we've always filed them as a self-employed proprietor. They make X, we deduct the expenses, they have net income, that net income lands on their personal tax return. And if they're, successful agents, they're up into the 40, 30, 40, 50% tax bracket. This past year, October, actually March, the legislation was introduced, effective in October, that real estate agents could create their own PRECs, personal real estate corp, which really meant we can flow their income through a corporation. Okay, a corporation is a separate legal entity. It has its own tax rates. Active business income in a corp is tax paid at 12.2%. Okay, 12.2. Okay, personally, the way I look at it, every individual is and I just use more of a concept in rounded numbers. Every individual has 4 tax brackets: 20%, 30%, 40%, and 50%. Your 20% bracket is zero income to $50,000 of taxable income. Your next bracket is 30%, which is 50 to 100 taxable income. Your next tax bracket is 40, which is 100 to 150 taxable income. And then your last tax bracket is 50%, and we're paying that attracts at about 150,000 and up. So take a real estate agent that, let's just say, made $125,000. Okay, if we put that under the old rules, we put that on their tax return, they're up into the 40% tax bracket. Under the new rules, we can channel that income through a corporation, pay 12.5%. So there's a significant savings. Now we have to pull the money out of the corp. Okay, now because we flowing income through a corporation, with a corporation, we can pay dividends. And without getting into the technical term of a dividend, dividends are paid out after a corporation has paid their 12.2% tax. So we can use a corporation. A real estate agent can have a successful practice business, income go into the corp. We can pay 12.5%. We can keep it in the corp. They can do their investing. They can buy their real estate properties. They can do whatever they want in that corp. We get to choose when we pull the money out personally. If we pull out about a $50,000 dividend, they are paying zero income tax. Zero. Okay, so we can flow income through a corp, pay 12.2%, and take almost 50,000 and pay zero income tax. Plus, when we pay them by a dividend, we are not paying Canada pension. Okay, now what does that mean? When we're under the old rules as self-employed people, they would have to put it on their personal tax return, they would pay income tax, and they would pay Canada pension. Now, Canada pension has just gone up 10%. The premiums that everybody pays has just gone up 10% on January 1. Okay, that's a significant increase. It's the first time ever on a 2020 tax return, if I put $50,000 of self-employed income, it's the first year ever that the Canada pension premium is higher than the income tax that we'd have to pay on $50,000. CPP is quite expensive. And so back to the dividend discussion, again, I don't want to get into all the complexities of it, but if we have an option, which we now do with realtors, to pay them as dividends through their corporations, we can choose if we want. We can pay them as a dividend. You're not going to pay Canada pension. We can pay you as a salary. You are going to pay Canada pension. What do you want to do, realtor? Do you want to pay Canada pension? Do you want to build up something for your future? Or do you want to not pay Canada pension and save that money and use it yourself to build up your own investment program? 9 out of 10 realtors so far have been quite happy not to pay that Canada pension. Okay, when we look at what an individual has actually contributed to their own Canada pension, first of all, everybody has their very own Canada pension account at CRA. Okay, you may know that, you may not. You can call CRA, you can get a printout of your very own Canada pension, and it'll show you all the premiums you paid since 1967, since it started, and it'll give you an estimate of what Canada pension you can expect when you're 65. You can do an early collection at 60. So you have your very own pension account. Okay, but when you figure out how much like even I look at mine and I look at how much I've put in and what they're going to give me, compared to what I could have done with that money, oh my God, they're just giving me a small fraction of what I should be getting from that CPP money. So anyway, so it's, with now the real estate agents have a choice, and they got a very good choice. This is the best thing that's ever happened for a real estate agent as far as their tax situation. So we've been quite busy talking to agents, incorporating agents. There's really, I can't see any reason unless an agent is just a part-time, looking to buy or sell 1 or 2 or 3 houses for clients during the year. Anybody above that really is going to have a benefit from a limited company, a corporation. So that's been good news in the real estate front. Plus, it allows the real estate agent to build that money inside of their corp and expand their business models. I talk to a lot of realtors. Like, I'm somebody who says, hey, real estate agent, you're an expert in real estate. You talk to your clients about real estate. Why don't you talk to them about REITs? And they're like looking at me like, what are you talking about? I said, why don't you talk to your clients about REITs? They're real estate products. So some get it, and I'm working with a lot of agents to actually expand their business models. And now with these corporations, they're in a position to do that, and it's a very lucrative business model.
And that could apply to other professionals as well, right? Mortgage brokers,
mortgage agents. Okay, mortgage agents, realtors. We're all talking to people about real estate. Mortgage agents, realtors. You're perceived as real estate experts. Why are you restricting your discussion about real estate and not expanding that discussion? It just makes so much sense, in my opinion. So.
All right, so people should contact you to talk more about that. We should maybe you want to type in your telephone number there, Gerry, in case in the comments, in case people want to give you a shout. There's a question from Joan Norcus. If the tax rates change, will it be retroactive or only affect capital gain in the future? And I also want to ask you about home office expenses, because I understand that's a contentious area now as well.
So again, there's tax rates, and then there's just messing around with components of the tax system. So tax rates, I'd be shocked if they go up. Okay, they're high now, and every time you increase a tax rate, the political fallout is, pretty bad. Now, if you look at the political reality, you've got a minority liberal government propped up by a left-wing NDP party. So those two parties could literally double our tax rate, and they'd be pretty happy about it. So it could happen. Again, so there's the tax rate themselves, which I'd be surprised if they increase. And then there's things like playing around with the principal residence exemption, playing around with capital gain inclusion rates. So I think you're going to see more messing around with things outside of the actual tax rates. They're just going to try to make more things taxable. And I do hope, I really do, I'm a believer in entrepreneur and small business, but I do hope they go after the large income earners. Okay, leave the people alone that are, making a half decent income, but those people that are making millions of dollars, go after them and make them pay some extra tax. But as we all know, the risk, these people, you tax them too much, they're gone. They go to another country. They literally reestablish themselves in a lower tax jurisdiction. So it's a fine line, but I do think the rich, the real rich, the real rich have been getting away with too much. And I'm a strong supporter that those really rich people need to pay more to our tax system. Leave the low income person alone, leave the person alone that's making 100 to 200, even leave the person loans making 250, go after the person that's making $1 million, go after them. So hopefully we see that.
Well, then, as you noted, though, then you see the brain drain, right? And some of our top top professionals end up leaving the country.
Well, that's where there should be more of a collaboration with all the all the countries. Come on, like the debt in Canada is not isolated. Every country is just overextended and so far in debt that if they didn't make it very easy for people to bounce around to lower tax jurisdictions, I think it's part of the solution. But there's just so many logistics to that it probably will never happen. But
Gerry, home office expenses. What's the story with home office? Why is that so complex issue now?
Yeah, hot topic. So, we all know March COVID hits and everybody gets pushed into their houses to work. So we're all on this Zoom, we're all upgrading our computers, we're all buying this and buying that. So the question is it tax deductible? So there's like a basic, so home office expense has always been a deductible expense for those people that are required by the terms of their employment to use their office home. This is before COVID. Okay, so if you were an employee working for a company and they required you to have office space at home, we would get them to file this form, which is called the T-2200, which the employer acknowledges that you need to work out of the house. And then we could start deducting some expenses. Okay, we can deduct your computer, your office desk, your this. We can deduct part of the costs, the actual costs of your house. So that was always in place. Now COVID hit, so now you get people who wouldn't have qualified for that type of deduction in the past, all of a sudden finding themselves working out of the house. And they're going, hey, what about me? I want to deduct my computer, this, that, and everything else. So they've created a standard deduction, $2 a day, up to 200 days, which is $400. So that's a standard deduction for anybody to claim. $400 deduction, which I think is really almost an insult. $400 deduction times a tax rate of 25%. They're giving you $100 to reestablish your house into an office. Come on, give me a break. So anyway, that's just the basic one. Then there's actually the old one, okay, which is, hey, you can go to your employer and go, hey, you've told me now to work at home. I want you to fill out this 2200. And I want to deduct all my home expenses. Some employers are doing that, some are not. The bigger the employer, the less likely that will happen, because if they do it for one, they have to do it for everyone. So I've seen a lot of employers be a little bit reluctant. Some are just saying, hey, the government's giving you a $400 deduction. That's enough. Which again, I think is a bit of an insult. So there's the old way and there's a new way. And then there's a form in the middle that you can get them to sign that you only need certain things. So there's 3 different categories now as far as office and home. But this brings up a whole other topic that I've been concerned about for almost 40 years now. And that is when we claim office in home, we're telling the government, hey, we use 10% of our house or whatever percentage we determine. We're using that for business purpose. So now you go back to the discussion about the principal residence exemption. And so far, the government to date has never stopped anybody from claiming the full principal residence exemption on a house that they may have claimed for business use for years. That is coming right at us. So if you're going to claim that you use your house for business purposes, and then you're going to try to say your house is 100% tax-free, there, I think we're going to have a problem, a big problem. And it's almost like they're setting us up for this. They're almost like, here, everybody, tell us that you're using your house for business purpose. And then they might create a law that says, oh, well, if you used your house for business purpose, you're not going to get your principal residence exemption. I feel the setup. I really do. I see it coming.
Gerry, did I put the right phone number there for you? I put in 519.
Yeah, so the 416 is my office number and the 519 is my cell number. So
Okay.
Anybody wants
So,
to get,
yeah, okay.
get, get
Here's a question. And then I also want you to, if you would, talk about some financial planning stuff that you've been working on. But first, there's a question from Hillary. Can you set up a personal real estate corporation, for one or more pre-con condos that are generating rental income, and how many properties can be put in a given prec?
Okay, first of all, a prec is specific for a real estate agent to flow their real estate commissions through. That's specific for a real estate agent. Anybody can set up a corporation, okay, for whatever they want to do. So yes, you can set up a corporation. You only set up a prec if you are a real estate agent, okay? So if you are a real estate agent, if you set up a prec, and the question is one or more pre-condos, you can put money down. That prec, the only restriction on a prec is that the real estate agent cannot market and promote that prec as being the entity that is buying and selling the house on behalf of the agent. That's the only restriction. Other than that, you can buy a pre-condo in a prec. How many properties can you hold in a prec? As many as you want. Okay, there's no restriction on the amount of properties that you can hold inside of a corporation, which leads to another discussion we're not going to have, but you may not want to, some people want to have a separate corporation for every real estate property they own. From a liability point of view, again, we talk about corporations not only for the 12.2% tax rate, but we also talk about a corporation from liability protection. A corporation is a separate legal entity. So if there's a litigation issue inside of the corporation, in theory, it protects you as a person from that litigation. So,
Gerry, talk to us about this financial planning software and this group that you've started. What's that all about?
So again, I'm an advocate that I just see most. I have a real problem with the way investment advice is dispersed to people, okay, in general. And I'm trying to create a better way for people. So 95% of the 95% of the financial planning advice that people get is simply designed to sell them a product that the person who's talking to them is licensed to sell. Okay, it's a very sad way that our investment industry is structured. In fact, if you have an investment license, you cannot even put the best interest of your client first. Okay, your fiduciary responsibility, the fiduciary responsibility of the licensed advisor goes from the client to the company that licenses them. In other words, when someone is licensed, they're being told to sell a product to their client. Okay, I have a problem with that because there's so many different options and products available to people. But when they deal with a licensed advisor, they don't have access to all these products. So much so that I'm somebody, I've held every license, MFDA, IROC, private equity, insurance, and mortgage. I've held them all. I've given them all up. Okay, so I have an investment business, but I do not hold a license that allows me to access all these products. Now, as I've said before, on the financial planning front, I strongly encourage people to separate. When you talk about financial planning, separate the financial planning process to the investment products you need inside of your plan. So I've actually created, I've used many different financial planning softwares, and none of them gave me what I wanted, which is just something very simple. I wanted this simple, easy to understand, easy to use, a financial snapshot of somebody's financial life just on one computer screen, just as a tool, not so much as a plan, just as a tool, an ongoing tool, a living document. So I created it, use it for my clients, and then now I'm giving it away for free, literally for free, no strings attached, no credit cards, no nothing. You can go to my website and you can download this financial planner. It's called Financial Vision. It is free, okay? Now, with any software or tool, there's a learning curve. So we have webinars. We've already had one, and we're having another one next Thursday. We teach people how to use this tool. And again, it is free, with the hope that once you figure out your own financial planning, I'm an advocate that you should do your own financial planning or at least become involved with it with a third party. Don't just give it to a third party and say, do my financial plan. Either do it yourself or give it to a third party, but be involved in the process, better understand it. So again, I invite you all to download it, join us on the webinar. There's no catches, there's no gimmicks. We're just teaching you how to use this software so you can do your own financial planning. And hopefully you use us to source investment products. That's what we do. We educate people, we give them information, and then you have to source investment products. And I'm about the most unbiased person out there because I don't have any investment license. Nobody's telling me to sell anything. So I kind of hold the client's hand into the investment marketplace, explain how it all works, figure out what you want. And if you want, I can go get it for you. So that's kind of how our system works. But go to the website, Canadian Investment Services, lots of information there. And again, feel free to download our webinar. If you do download the software, you'll automatically get an invite to our webinars. We're probably going to have 3 or 4 or 5 of them in the next 2 or 3 months.
So it's on the website. So Gerry, I'm just wondering, like, it must be very difficult for you. Like you have very high standards and a lot of experience. So how do you choose the individuals that you work with? Like if you need to source an investment product, let's say for private equity, like how would you possibly choose who is the best dealing representative to deal with that?
Well, okay. So again, what we do is we try to encourage you to do your own financial planning. Then once we work with you or you work on your own, again, you need investment products to put into your plan. And we start talking to you about what do you like? Not what do I think is best for you. What do you like? When we look at all the risk and reward, parameters, and most people like real estate. And then we further dig a little deeper into the real estate. And if we do find that you like real estate income trusts, I'm not licensed. I cannot process the order for you. We have to go to a licensed dealing rep. And I happen to know somebody, my good friend David Grossman. And you should tell the world here, because you're a mortgage agent, but you're also become a licensed dealing rep in the private equity world, which I was so happy you did that, because you are somebody that I can use within my business model to facilitate these type of investments for clients. So why don't you maybe take the stage and explain, your journey to becoming a dealing rep?
Well, thanks, Gerry. Yeah, I mean, I found a number of years ago in my business that as a mortgage broker and mortgage agent, that not everybody is looking for a mortgage at any given time, but most people are thinking about their investments. And so that's why I also, like you, spent time researching and finding what investment options there are and different investment alternatives. And that's what led me to this path, because I did see that there were some great products available in the private market. And we could probably do a whole show on that, on private investments and private equity, which is something we should consider. But for now, I think the important message here is that this is an area that you have been working on for decades: real estate investments, alternatives for people, how to be tax efficient, how to structure your income and your investments in a tax efficient way. I've put the link. The link is on the comments to your website, Canadian Investment Services. So would encourage people to go there, and they can actually download the software and get information about these regular workshops and sessions. And I've also posted your phone number, both your 516 and 519. So if there's any questions that we have not answered, please do give Gerry a call. And I'll also post my phone number as well if anybody would like to talk to me about private investments from the standpoint of a dealing rep. I'd be happy to comment. And of course, as a mortgage broker, if there's any mortgage related queries, that's a space where I'm most active, and would be happy to take your inquiries. Final thoughts, Gerry, before we wrap
Yeah.
up?
Well, I just, I really commend you for what you said there is that, you're a mortgage agent broker, but not everybody needs you for a mortgage. So to all mortgage agents, brokers, real estate agents, expand your business model. You're real estate experts. Talk to your clients about real estate income trust or different type of real estate investments. When I look at real estate as an investment, I look at it, you can own real estate or you can lend against real estate. You can own it individually, just owning your own rental property. You can own it as a group, which is a real estate income trust. You can lend against it, private mortgage lending on your own. You can do it as a group, which is a syndicated mortgage, which in too many cases is a bad word, but it really isn't. A syndicated mortgage, most of these syndicated mortgages are geared towards funding soft cost for a parking lot that they're going to build a 50-unit tower. So I would stay away from those, just my opinion. But, I'm working on a deal now in Hamilton where we're going to buy a 20-unit apartment building where we're going to own 60% of it. And the investors that come in, we're going to put a syndicated mortgage against that building. So the building's already standing. It's already there. It's not a parking lot that's built, going to be building on a concept. So we use a syndication mortgage. We registered second behind a bank and we put all the investors' name on title. So there's a good use of a syndicated mortgage. So again, real estate is just the basis for, different types of investment decisions. So in closing, I don't know, David, thank you for hosting this session. You had a good turnout, lots of questions. I mean, I can't even get to, somebody asked tax rates, will it be retroactive? I've never seen a tax rate that is retroactive. So hopefully not the first time. I can't see them ever doing that. But, thank you for having this session. Thank you for inviting me. Very interested crowd, lots of questions. Sorry, I can't get to them all. I mean, unless we want to hang on for a while, but there's a lot of questions here.
Okay, thanks a lot, Gerry, and thanks everybody for joining, and we'll see you next time. Bye for now.
Thanks, David. It was fabulous. Really fabulous. And Gerry too, thank you.
Yep.
Thanks, Michelle. Thanks, Cam.
You're most welcome. Have a wonderful day and stay safe, everyone.
Have a great day. Take care.
Thank you.
Thank
Bye-bye.
you. Bye.
Bye-bye.
Gerry, I'd like to talk to you later.
Thank you.